Now that we've looked at how to record the entries for a notes receivable, now let's take a look at how the entries would differ if we're dealing with a notes payable. So in other words, if our company has borrowed money rather than loaned money. So I'm keeping all of the figures and time periods the same to illustrate the difference. So starting with the entry to record the issuance of the notes payable, we will debit cash for $15,000 because we're borrowing that cash, and credit the liability account notes payable. So since this note is not due until February 4th, we need to accrue the interest expense incurred on this note through December 31, our fiscal year end. And previously, when we did this for a notes receivable, remember we debited interest receivable and credited interest revenue. Well, now with this notes payable, because we're borrowing money, we're incurring interest expense, so we'll debit that account. And we have a liability for this amount of interest due as of December 31st. So we'll credit interest payable. So when we repay the note, this will be our entry. We'll credit cash for $15,450, which includes our repayment of the principal balance plus $450, which represents 90 days worth of interest. We'll also debit notes payable to remove that liability from our books, and debit interest payable for the amount of liability we had set up back on December 31st of the previous fiscal year. And then finally, we'll have a debit to interest expense for $175, and that's the amount of interest expense that we incurred from January 1 of this new fiscal year to February 4th, the due date of the note payable.